So let's talk about Chipotle. I'm a fan of the company. Anything that takes meat and rice and puts it in a nice burrito or some kind of a bowl, it's perfect for me. Hits my macros, got a great amount of protein, and then I can just crank up the rice to get the amount of carbs I need. But it's $10 for a burrito now. It's not really justifiable for me, especially when I am the kind of guy who, at 6'7", needs double meat, double rice in my burrito bowl. And so I've not been going out to eat there as much, and neither has anyone else because the stock's getting absolutely killed. So it just had earnings, and they came out, same store sales were light. They were missing analyst expectations. They also lowered their outlook. They lowered their guidance for same store sales, basically saying we're not going to be growing as a company anytime soon. And investors are panicking on the stock. The stock had a really nice run in 2024, jamming up to 70 after a stock split, and it's nearly been cut in half. So here's the dirty little secret about Chipotle and other growth momentum restaurant style stocks is that they get cut in half all the time. I've seen Starbucks get killed. I've seen Chipotle get killed. Even McDonald's takes it on the chin every once in a while. That's just the normal cycle for these kinds of names. But you do have a lot of bag holders who have purchased over the past 2 years that are now stuck in a trade that they want to get out of. But at some point, this stock is going to become a good value, right? At some point, institutions are going to step in and start allocating more capital, because as the stock gets killed and as the price starts to reflect the expectations of what's going to happen over the next 12 months, once that price gets low enough, all of a sudden the value of the stock is reasonable. And then you start saying, you know what, there's enough cash flow to really justify buying at certain prices. Now, I'm not going to try and be an expert restaurant analyst. In fact, I'm not going to be the one to try and step in front of this freight train. But what we can do is look at past price history to see the last instance in which we saw very large institutional buying. And in order to do this, we've actually got to back out and look at a weekly chart. So what we want to look at here is the right side. See all of this blue? This is going to be our volume by price. All right. So this gives us a sense of how much trade action happens at certain prices. So instead of looking at volume by time, we look at volume as a function of price levels, and actually can give us some very solid price levels to work from. So if we were to back this out and we went back to the 2017 lows, you can see that's where most of the trade action happened, but that's because it was a much smaller priced stock. You have a lot more volume traded at $10 versus when you're trading at $60. I don't think we're going to fully round trip down to the 2017 lows. I don't even think we're going to hit the 2020 COVID lows. It's probably going to be somewhere in this area, this trading range from 2021 to 2023, when it had that really nice breakout and it's fully round tripping. So if we allow our software to adjust and figure out where this is, the biggest spot in which we have seen the most trade action and the most trade volume, this point of control, is right around $29 to $30. So if the stock were to sell off an additional 8 points, that would get us to $30. I'm not sure we're going to get that unless there's some kind of a very hard panic, but that would be the buy with both hands price, especially if we get it without any kind of bounce or any kind of retracement. If the stock just pukes down to $30, you just got to buy. But just above that, and we are coming into another solid liquidity zone right here, we've got the lower edge of this volume shelf is right around 35.82. The upper edge, we're coming into it at 38.44. What often happens is that if the stock wants to bottom, you will see a very predictable price pattern where the stock will sell off to the lower edge, and then it will retest the upper edge, and if it makes a higher low and starts to break out, then that's probably the bottom for the stock. We don't know if that's going to happen just yet, but that's the first thing I'm going to be looking at. If it bounces and then it completely falls out, then 30 bucks is probably up on deck. But if we get some kind of pull into 35, a bounce back to 39, and then some kind of a higher low that develops right there, I think that's going to be a good place to put on some risk. If you wanted to play this with options, what you want to do is structure your trade with out of the money calls. I don't think it makes sense to be selling puts. I don't think it makes sense to be loading up on covered calls or things like that, because it does expose you to a lot of downside. And when these stocks, when they're in deep bear markets, when they have that bounce is incredibly vicious, and the market tends to underprice those call options, which gives you an additional edge. So I would be targeting the other liquidity zone right here at $41. So I would be looking at, for example, the March expiration, so give it about 6 months worth of time, and buying either the 40 or the 42.5 call. If the stock sells off hard into that lower edge right here at 35 bucks, I think it's worth a shot to buy some of those calls, because they're going to be drastically underpriced. And then if the whole thing collapses down to 30 bucks, then I would be looking at just buying the $35 or maybe just adding to the $40 call option as well. So a lot of people are panicking right now. A lot of bag holders are stuck in this stock, but at some point, the institutions who have left footprints in the volume of the stock are going to come back in, because they see that the stock is going to be of value. We're not trying to predict where the value is. We are just following the footprints of the institutional traders so we can step in alongside them and ride their coattails. If you'd like to learn how to do this better and learn our approach at Precision Volume Alerts, you can go to precisionvolumealerts.com, and there will be an opt-in form that will get you to a free training that will show you exactly how to do this and why we use options to structure our risk as well. So I highly encourage you to do that, and then I look forward to seeing you on the other side. Take care.